What I have for you today is an interesting TP/customs case about triangulation, and it involves a Argentinian company, Malteria Pampa, which is a member of the AMBEV group. And as you can see here, it is a decision from the Argentinian tax court, I think would be the most accurate translation. It is translated from Spanish, so maybe I got some details here and there wrong. My apologies if I did. So here are the facts. It was a typical triangulation case. Malteria Pampa in Argentina shipped 14,500 tons of malt or barley, I'm not sure, to a sister company in Brazil called Compañía de Bebidas Américas, except the invoice stream went from Malteria Pampa to Malteria Uruguay for $300 per ton, and then Malteria Uruguay, which is a low tax jurisdiction, invoiced the Brazilian company for $350 per ton. And what happened was the Argentinian customs authorities found out about this, and they used the Indira system to do this. And we'll come to what the Indira system is in a bit, but it's basically a computerized system in Mercosur for tracking customs declarations and things like that. They adjusted the Argentinian export value up by $725,000 being the price that the Brazilian company paid for the malt, and they added a fine of $2.2 million to Malteria Pampa. Obviously, Malteria Pampa was not very happy with this, and they appealed, and we are now at the level of appeal of the appeal court, and we've got two judges saying that Malteria should pay and a dissenting judge saying that it shouldn't. And the lines of argumentation is quite interesting, because the dissenting judge Segura starts by saying it is necessary to analyze whether this is a genuine triangulated operation with regular successive sales or harmful triangulation. Triangulation in itself is not prohibited. So he clearly says, you can do it if you have commercial reasons and you can prove that, right? And then he says the fact that the same goods that were sold to Malteria Pampa to the firm Malteria Uruguay entered the Brazilian market for a higher value does not constitute sufficient evidence to the first value not being the real value. So he says, listen, this is a huge penalty, right? So you need to prove that this was the case. We can see what happened, but we cannot see that this was for the purpose of committing tax fraud, basically. And he ends his decision saying, I consider that the decision appealed against in these proceedings should be revoked with costs. In other words, the taxpayer should win. And he quotes some case law which he believes is in his favor. And then the majority opinion is different, and this is written by the judge, by the president of the tax court, if I understand correctly, Judge Licht. And he says as follows, and this is an interesting discussion, because now you think that this will be about evidence, right? Is there evidence or is there not evidence? But the judge takes a different tack. He says different evidence standards apply in different sectors, such as preponderant evidence in civil matters, beyond reasonable doubt in criminal matters, and clear and convincing evidence in other non-criminal cases. Thus, the vexata accusatio consists in elucidating how much and of what quality the evidence must be in order for the administration to be able to validly sanction. And he then goes on to discuss this, and he says, after several pages of discussion, he says everybody is aware that circumstantial evidence is a source of knowledge when it is not possible to reach alternative conclusions that enjoy the same degree of probability, and the conclusion of the reasoning does not contradict other facts that have been declared proven. To simplify, the judge says, we could say that evidence must comply with the rules of logic and experience. So you can use circumstantial evidence also in this customs case, right? And then he goes on to say it is no less true that the accused bears the burden of breaking certain links that may be concatenated with each other. So he also says, the accused can, but the accused must also, if the story based on circumstantial evidence is wrong, bring up facts that contradict the theory, right? A very interesting view. And then he goes and he applies TP rules to the case. And this is why I discuss this case also here, because it's a customs case, but it is very much involving TP as well. And it says it's also worth mentioning that the OECD customs guidelines recommend cooperation between tax and customs administrations in a country to assess transfer prices, right? And then he quotes a number of paragraphs. He says, in turn, the exporting company justifies the value, where he now describes the facts declared to Uruguay, stating, this agreed sales price is the market price. It adds that the higher price agreed for the second sale is obvious given the essence of this trader's business. And what you as a transfer pricing specialist would expect here is that Uruguay is either carrying some risks, which Argentina is not doing, or is adding some value, which Argentina is not doing, and that's what the taxpayer try to argue here. It insists that these differences, and there's more arguments, I'm just quoting the part of this, these differences tend to exist and respond to market conditions. It clarifies, it being the taxpayer, that the export and sales conditions of Argentine exporters are defined by the sales agreed between them and their buyers. These buyers, in some cases, companies dedicated to intermediation and commercialization of these type of products, assume the risks inherent to their business derived from the interconnection of world supply. So what he says is Uruguay is a world player. It knows the market. It knows where to sell best at the best prices and the best conditions, etc., etc. And apparently Argentina does not have that knowledge. And then the judge pushes back and says, from the analysis of the document file, it does not appear which of these causes justify the higher price of the sale of Malteria Uruguay to Brazil. Neither do they explain the higher price of the alleged comparable transactions attached by the plaintiff. So the plaintiff came with comparable transactions. Although they include transactions between October 2006 and December 2007, which is also the period in which we had our own transactions, none of them show a volume even close to 14,500 metric tons, as is in the present case, with the highest volume being 1,500 tons between February, with destination to Brazil reaching a unit price of 295. So he says, you show me comparables, but the volumes are completely different, and I don't know why the volumes make a difference here, right? But there is a comparability issue here, and then the judge goes on to say, on the other hand, a list of exports out of Argentina, February 2007, which is the month in which our transactions happened, source Penta transaction, where transactions to Brazil can be observed, indicated a unit price between $285 and $340 per ton for total shipments between 24,000 and 9,500 tons respectively. So this is covering the 14,500 range. And it is added as evidence accompanying the appeal, right? So the judge says you need to compare the same type of volumes when you want to do this. And he concludes, in summary, the tax authorities succeeded in demonstrating price inconsistencies in the context of transactions between related parties without the appellant having been able to justify the differences. And so basically the tax authorities win because the tax court decides that the level of proof required in administrative penalties cases, which is what this 2.2 million has been, is lower than in criminal cases. And the judge several times referred to the fact that no one is going to jail here. It is an administrative, it's a monetary penalty. I think it's an interesting case, and there are a number of references that I just want to clarify here. First of all, what is Mercosur? Should anyone not know, this is a cooperation between a number of South American countries. So we're talking about Argentina, Brazil, Paraguay, Uruguay, and later on Bolivia and Venezuela. And it is an open and dynamic process, and I will leave the rest for you to read if you're interested. And then what about Indira? Now, Indira is a computerized system implemented among the member states of Mercosur. The Customs Administration exchange international information through an online database, a tool that permits them to analyze the risks, thus improving the controls of international supply chain. And then I talk about the creation of the Indira system. And so what the Argentinian tax authorities did here is they went into the Indira system, compared the sales price and export prices for Argentina to the import prices for Brazil on the same vessel, and they could see what it was exactly the same shipment. And one of the things that the taxpayer claimed was this was an abuse of the system, and the court rightly completely ignored that argument. And then the judge referred to the OECD. So let's just look at what the OECD guidelines themselves say on triangulation and customs valuations. And the first quote is paragraph 222 on cups, right? And even though the guidelines do not mention triangulation anymore, this text came in there because of the following scenario that was discussed. And this was that you had South African companies that would export gold to China. And the South African revenue noticed that this gold, even though it was shipped directly to China, was sold first to Uruguay, and from Uruguay to Switzerland, and from Switzerland to Singapore, and from Singapore or Hong Kong, finally to China. And the price at what China paid for the gold was much, much higher than the price for which South Africa sold, right? And all the companies in between that were up until the company that sold to China were related parties. So obviously all the profits that should have been in South Africa or could have been in South Africa ended up in Uruguay and Switzerland and Singapore or Hong Kong. And this is what this text has to do with, because what these companies do is they play with the shipping dates, and make sure that that South Africa just happened to have sold at a very low price of gold day, and then that Uruguay just happened to have sold at a higher price of gold day, according to the official reports that you see in newspapers and things. And so what the OECD said about this was, a particularly relevant factor for commodity transactions determined by reference to the quoted price is the pricing date, which refers to the specific time, date, or time period selected by the parties to determine the price of the commodity transactions. Where the taxpayer can prove reliably, can provide reliable evidence of the pricing date agreed by the associated enterprise in controlled commodity transaction at the time the transaction was entered into, and this is consistent with the actual conduct of the parties, tax administration should determine the price for the commodity transaction by reference to a pricing date agreed by the associated enterprise. However, if you have your South African type scenario and the dates are unclear and all those things, then you simply go and the OECD says if the pricing date specified in any written agreement between the associated enterprises is inconsistent with the actual conduct of the parties, tax administration may determine a different price date consistent with other facts of the case. Tax administration may deem the pricing date of the commodity transaction on the basis of evidence available to the tax administration. This may be the date of shipment as evidenced by the bill of lading or equivalent document depending on the means of transport. So if they fool around with the dates, simply use the shipping date and nothing else, right? This is what the OECD recommends. And then it also talks very specifically about the use of customs valuations in paragraph 1157. And it says the arm's length principle is applied, but this is also what the judge referred to, broadly speaking, by many customs administrations as a principle of comparison between the value attributable to goods imported by associated enterprises, which may be affected by the special relationship between them, so when they are related parties. But remember, the customs have their own transfer pricing rules, right? And the value, the OECD says, for similar goods imported by the independent enterprises. Valuation methods for custom purposes, here it comes, however, may not be aligned with the OECD's recognized transfer pricing methods. That being said, customs valuations may be useful to tax administration in evaluating the arm's length character of a controlled transaction transfer price and vice versa. Right? And then finally, this case was about Argentina. The case itself does talk about the high penalties for misdeclaring customs, and I want to make you aware of this source that is very useful. And this is Deloitte published, at least in 2018, a country guide named The Link Between Transfer Pricing and Customs Valuation. And I haven't seen an update. If anyone is aware of any update, please let me know. But it is extremely useful, and it deals, for instance, with year-end adjustments, right? And so it asks the question. It has for a number of countries the same questions and then the relevant country answer. And here it says, are there any custom-related fines, penalties, or interest that could result from a change to customs value due to a retroactive transfer pricing adjustment? If yes, provide a brief description of the applicable fines, penalties, and interest, right? And the answer that Deloitte gives is yes, fines of 1 to 5 times the tax loss or the difference in the price paid or payable may be assessed. Voluntary disclosure does not eliminate these penalties. However, a reduction of 75% may apply should the importer report the change in customs value within 30 days of the original customs clearance of goods. Now, obviously, it's going to be virtually impossible to make an adjustment within 30 days if you are talking about a year-end adjustment, because you're basically adjusting the last 5 or the last 11 months, right? So this is not very workable. And I've come across this in real life, and what we've been told was that this potential penalty of up to 500%, and you saw in this case it was 2.2 million on an adjustment of 750,000, can apply even if you have overcharged, for instance, your Argentinian distributor initially, and you need to reduce the price to bring them back into the range for transfer pricing purposes, meaning that you've initially paid too much customs and you don't even want the refund. You just want to adjust the price downwards so your Argentinian distributor makes an arm's length profit. Even in that case, one may risk a 1 to 5 times penalty. If anyone can confirm or deny or refute this, I would be very interested in hearing that. And if you have an update of this manual, I would be very interested in receiving a copy for it. Otherwise, we will talk about more tax cases next week. Bye for now.